one of the first homework problems in your first financial accounting class is probably going to have something to do with creating an income statement, a statement of owner's equity, and a balance sheet from a list of accounts. So let's run through a quick example of what that might look like. So two things right off the bat. Sometimes these accounts are listed in alphabetical order, sometimes they're in random order. And secondly, we've got to identify the type of entity we're dealing with here. This is LL Inc. So we're talking about a corporation. So our statement of owner's equity is going to be a statement of retained earnings. Retained earnings at the beginning plus net income minus dividends gives us retained earnings at the end. But before we get there, let's do the income statement first. Revenue minus expenses. This problem's pretty straightforward. It calls that account revenue. It might have called it sales. It might have called it commission revenue. It might have called it medical revenue. It might have called it consulting revenue. It's whatever our sales are called, whatever our business is, we're going to have a different name for it. And remember, the income statement is a report card. It covers a period of time. Revenue or sales minus our expenses to generate those sales gives us our net income. It's as simple as that. Here's the name of the company, the title of the financial statement, the time period covered. Remember, the income statement covers a period of time. Revenue minus expenses gives us net income. Dollar sign at the top, dollar sign at the bottom, double underline shows the world that we're done. If we had a bunch of expenses, we might have started a column here that listed all the expenses, then totaled them. But in this case, our expenses are already totaled for us. Revenue minus expenses gives us net income. And when you're doing these homework problems or on an exam or in class, my best advice to you is to cross off these accounts as we use them. That way you don't accidentally use one twice and you don't accidentally forget one. Next is the statement of retained earnings. I ask my students to memorize retained earnings at the beginning, $75,000, plus net income, the $200,000 we just calculated, minus dividends of $10,000 gives us retained earnings at the end. So there's our statement of retained earnings. In the real world, we'd say retained earnings at January 1st, 2020, and then we'd say retained earnings at the end, December 31st, 2020. But I just want you guys to remember retained earnings at the beginning plus net income minus dividends gives us retained earnings at the end. And as you've already observed, there's the name of the company, there's the title of the statement, there's the period covered, dollar sign at the top, dollar sign at the bottom, double underline shows the world that we're done. Then finally, we'll create the balance sheet, but we'll use this new retained earnings number when we create that balance sheet. Left-hand side is assets, things that we own. It's a snapshot at a moment of time of what we own versus what we owe. And what we own here are things like cash, accounts receivable. Accounts receivable is the good one. It means we're going to receive money in the future. And land. So I see three assets, three things that we own that are going to provide us with future financial benefits. Here's the name of the company. Here's the title of the financial statement. There's the date. It is as a moment in time. It does not cover a period. It's as of December 31st. We had this much cash in the bank. We had this many invoices outstanding to our customers. And this is the cost of the land that we bought. Dollar sign at the top, dollar sign at the bottom, double underline shows the world that we're done. And we list them in order of liquidity. This is cash. This will be cash shortly. This may not be cash for a long time. There are two types of accounts on the right-hand side of the balance sheet. Liabilities, stuff we owe to people on the outside of the company, and owner's equity, the difference between what we own and what we owe. In this case, there are two liability accounts. Accounts payable, any account that has the word payable, unearned, or accrued in it is a liability account, and a long-term debt. If we wanted to get fancy, we could strike a subtotal there that said total liabilities. Now let's get to the equity accounts. We've got common stock. Let's pretend like that's the common stock par value. So there's no additional paid-in capital. We'll talk about that later. And then we'll just use this retained earnings number that we calculated. Retained earnings at the beginning plus net income minus dividends gives us retained earnings at the end. And our balance sheet balances, $330,000 worth of liabilities and owner's equity, and $330,000 worth of total assets. So one of the mistakes beginning students often make is they try to put revenue and expenses onto the balance sheet. They are not there directly. They get there eventually because revenue minus expenses gives us net income. Net income gets folded into retained earnings, and that balance shows up on the balance sheet at the end of the year. But there are no revenue or rent expense or supplies expense on the balance sheet. I hope that helps.